Welcome to today's webinar. I'm Claire Rychlewski, Deputy Editor at Mergermarket. I want to thank you all so much for joining us today as we explore the opportunities and challenges of diversifying into distressed M&A. In this time of uncertainty, Mergermarket hopes to continue to bring you news that will help clarify complex situations and support the community. Couple of points on housekeeping before we get started today. We will be taking questions throughout today's webinar, so please make sure to submit questions via the question box below. The team will push these through to us as we go, but there will be time at the end for Q&A as well. We also have some polling questions for you to answer below, so please take a moment to share your thoughts, and we will discuss the results later in the webinar. And finally, this is a live event, so please bear with us on any technical issues. Thanks so much for your understanding on this. Before we get started with our main discussion, my colleague Phil Siegel will set the scene for us with a few slides exploring recent distressed M&A trends. Phil, I'll turn it over to you.
Hey, Claire, thanks. Let me share my screen quickly. Yeah, so, we've already seen an increase in the number of sort of distressed assets that have been taking place. So far this year, we've seen, 59 in the first half of 2020, and that's up from, about 48 that we saw in the first half of 2019. So, there definitely is some more activity, in the pipelines. I would just, expect that as companies sort of go through those bankruptcy processes, the life cycle of those, you might see some more deals getting announced. An example of that being, Gordian Dairy was just acquired by KKR and Capital Peak, and they first, went into distressed, earlier in the year, back in January. But looking at the activity that we've seen, so far this year, I think consumer is definitely a big sector that we've seen a lot of sort of deal flow. But also, on the left-hand side, if you look, we did see, rather large, in industrial and chemicals deal, and that was Loomis Technology. They're a petrochemical company, and that was part of the sort of, McDermott International situation going on. Some of the other, deals that we've seen more recently that are sort of not in the sort of consumer sector, OneWeb Limited being acquired for about $1 billion, Global Eagle Entertainment, and Briggs and Stratton, they're not sort of consumer, but, for instance, Global Eagle is in-flight entertainment. So I think it definitely points to some of the more direct situations influenced by COVID. I did want to take a little bit of a focus on retail. So these are the sort of bankruptcy processes that we've seen, and I pulled this data from DebtWire's sister publication to Mergermarket. And in the first sort of weeks of the sort of lockdown phases and things like that, we did see some names come out. Dean DeLuca, True Religion, J. Crew, and some of those have led to deals. I think J. Crew is in the middle of a negotiation with creditors, and same with Neiman Marcus. And then in the sort of later stage, I think J.C. Penney's also working with Sycamore right now on a deal. I don't think it's been announced yet. Then if you look sort of towards in the last few weeks, we have seen some more in the consumer retail space. Brooks Brothers was a deal that was recently announced. Ascena, Latote, and Taylor Brands. I think the total of which bought Lord and Taylor just last year. So I think that's definitely an interesting, situation to look at. I did want to, before I wrap up, I do want to point to an op we have included as a PDF to this. We put out this report last week on, corporate attorneys with experience in distressed M&A. And how they've sort of changed firms over the year, over the half the year. So it's definitely an interesting to look at if you're looking at the space. So I think I'll wrap up there, and I'll pass it back to Claire.
Thanks, Phil. I'm now going to ask our panelists to introduce themselves, and I think we'll start with Peter Martenson.
Well, thank you, Claire, and thank you everyone for joining us today. This is a great event, and I'm glad we get to chat about it. I am Peter Martenson. I'm with Eaton Partners. We're a business unit of Stifel Investment Bank, and we're a boutique investment bank focused on the private capital markets. Specifically, our group primarily raises money for the classic commingled funds that are focused on stress, distress, as well as private equity, venture capital, and the likes. We have 9 offices and 80 people around the world that are focused specifically on this. We raise about $15 billion a year in about 20 projects. My background is having been in the industry for about 20 years. 10 of it began on the buy side as a limited partner and a consultant for limited partners, large and small. Then for the last 10 years, I've been working with Eaton Partners as we've raised capital around the world, going through GFC, through the last cycle, and now into this latest, at least dislocation event. So happy to be here and look forward to the conversation.
Thanks, Peter. Let's go to Mark.
Morning. So my name is Mark Williams. For the last 5 years, I've been responsible for Data Sites Americas business. We support all forms of kind of virtual data room requirements that companies might have, whether it's sell side, restructuring, capital raise, things like that. And appreciate the opportunity to participate today.
Thanks, Mark. And finally, Peter Kaufman.
Good morning. Thank you for including me. I am the president of boutique investment bank Gordian Group. I'm also the head of our restructuring distressed M&A practice. We have a unique niche in the restructuring world. All we do is represent sponsors, boards, and shareholders. We do not represent financial creditors, so that we can try to be the only one who can give unconflicted advice to a board seeking to advantage shareholders in tough situations. Financial creditors don't like us too much, but sponsors and boards and shareholders like us a lot.
Thanks, Peter, and thanks all for joining us today. We're living in an extraordinary age, and we're seeing the market respond in real time. So before we start, I'd just like to take stock of how our audience is viewing this environment. So let's take a moment to answer the poll on market sentiment. So what is your outlook for distressed M&A now and going forward? Positive, neutral, negative? And we'll give you all a moment to answer. Oh, I think we swapped that question out. All right, well, everyone's bearing with us. Let's then go to a different polling question. Okay, what will be the largest driver of event-driven M&A activity this year? Okay, so we've got 40% have said PE dry powder, 10% have said corporate acquisitions, 10% have said defensive carve-outs, and 40% bankruptcies. So we've got a pretty clear and even split. Okay, let's turn to our panelists. How much stress are you seeing in the market at the moment? And do you think the Fed's actions are dislocating the distress cycle we were expecting to see? Why don't we start with Peter Martenson on this, and then we'll go to Mark and Peter Kaufman.
Yeah, I mean, that's a good question. I think, I guess the cut to the chase, which is, what we're seeing out there, and we see it through a lot of our fund managers, our GPs who are investing into this space with their current portfolio companies, as well as the opportunities they're looking at. I would say that certainly the Fed's action are extenuating the cycle. And what I mean by that is there's a level of uncertainty on, how things are moving forward, as well as the liquidity that's been introduced in many cases has helped potential targets, move to the right and, continue to operate and not quite move into the distress. So that may be a good thing from our perspective. And the reason being is rather than a V-shaped type of distress cycle, it'll be more extended. So the opportunity set for investing will be extended, as well as the company's chance to perform and move through it will be extended as well.
Great. Mark, can you comment on that?
Yeah, I think we expected when the cycle first started to see a lot more intensity with distressed. The Fed's action certainly slowed that, as it gave breathing room to companies to adjust their outlook. It gave their investors an opportunity to kind of look through the immediacy of what was going to happen. And so we've seen, obviously we are not involved in the transactions, we support the transactions. So one of the things that's been very interesting for us is to look at the search results across our platform and see what kind of due diligence kind of potential investors or current investors are doing with either portfolio companies they are holding and what the impact's going to be for those, or on companies that are in market and what type of due diligence they're doing. Certainly force majeure is a well-searched topic at the moment.
Great, thanks. Peter Kaufman?
What was the exact question again, please?
Sure, yeah, no worries. How much stress are you seeing in the market at the moment? And do you think the Fed's actions are dislocating the distress cycle that we were expecting to see?
Well, I think the Feds can ameliorate things, but they can't change things. They can extend the timeline where things are going to happen. The stress that we're seeing up front in the trenches is that the dynamic between lenders and companies and boards is a little different than it has been. It's a lot different. You have lenders who are scared of uncertainty. They don't deal with uncertainty well. And so they want sponsors or corporate boards to keep putting equity under what we call Mount debt. You've got companies who've been directly and severely impacted by COVID, and their revenues have dropped to the floor. Their profitability has disappeared in certain consumer-facing and indirectly consumer-facing industries. And the lenders would like to kick the can down the road. They'd like to give 3 or 6 month forbearances, and they want more capital to come in to prop up the debt. Sponsors and companies, on the other hand, if they're nimble, would like to take advantage of the uncertainty here and try to get a global fix quickly with the lenders. And what we're seeing a lot of, what we're accomplishing a lot of, is getting, if not a right sizing of the balance sheet, at least a 2-year runway with covenant holidays, except for potentially minimum liquidity with unlimited ability to cure. So that's where the tension is. The smart companies want to get a global fix right now, and the lenders would like to just incrementally move the ball down the road because they can't see where things are going to go. Not that anybody can see where things are going to go, but it's simply who's going to try to take advantage of the uncertainty to their advantage right now.
Great, thanks so much. Let's talk a bit about fundraising. Peter Martenson, what does the appetite look like for fundraising on the private equity side in today's market?
Yeah, I mean, a great question again, Claire. What we're seeing is twofold. Of course, on the fund manager GP side, they have a tendency to always like to fundraise, which of course we appreciate working with them on that. What we're hearing from the limited partners out there is an interest in investing, which is a little bit different than the last financial crisis. In the last financial crisis, the LPs kind of stepped back from the table and said, hey, we're going to go on a holiday for 6, 12, 18 months, let things settle out. What we're seeing in this current cycle is the LPs are saying, hey, I want to take advantage of this dislocation, invest with fund managers that I want to back, and find compelling opportunities. And so what we're seeing, at least that's being articulated. We're seeing also with the stock market where it is, et cetera, people are feeling more comfortable with their overall portfolios and therefore their allocation of the private capital markets. Finally, where it hits, the rubber hits the road here, that has been a little bit, I think, not surprising. We saw it in the last cycle, but interesting is because of the lack of ability to travel, the capital that is being raised, and there has been capital raised during this COVID environment, even without travel significantly, is going to the incumbents or re-ups, as people would say. So it's become harder for first-time funds managers to raise capital because they can't go out there and do that meeting in person that everyone likes. And so, the capital is going to the incumbents. First-time fund managers, are having to adjust a little bit, do virtual road shows, things like that, to help the LPs get comfortable. But, there seems to be a strong interest here, and I think we'll see it in the capital raising numbers, and certainly in the second half here as well.
Fantastic, thanks. Peter, this may be another question for you, Peter Martenson, that is, are firms raising new funds specifically for distressed assets in special situations or with existing mandate and LP appetite?
Sure. Both is probably the best way to just give the answer. What we're seeing is, that incumbents as well as new managers certainly are coming out with innovative strategies to take advantage of the opportunity set. We're seeing and working with managers that are doing things like, going after a non-performing loan opportunity in Europe that certainly has been exacerbated by the situation. We're seeing and working with managers that are going after the opportunity in CLOs, again, given the dislocation that occurred. And finally, those are fairly new strategies. We're also seeing people take their current strategies, which in many cases are your classic buyout, and turning it more into that all-weather strategy, going after, if not distressed companies, stressed companies that are on their way to being distressed, and trying to get them early, find what they'd call good companies with troubled balance sheets. So we're seeing a lot of new strategies. In fact, probably every strategy that is fundraising today has to be positioned to take advantage of the dislocation that is occurring. That is something where I think the investors are looking for that, because that is what they want to do when they invest today now.
Thanks so much. A question for Mark, or we'll start with Mark. In this market, how are stakeholders differentiating between event-driven investing versus more straightforward chasing of distressed assets?
I think when we look at the use of our platform, certainly mid-March, we saw what I would call the first phase, which was portfolio companies, or kind of PE firms looking at their portfolio companies and making sure that they had a balance sheet that was set up for to see them through this period, which nobody really had a view on what the end would be. So we saw a lot of activity there. In the second phase, once people had a view of what that looked like, and obviously we referenced that the Fed, their actions elongated or gave some breathing room to that, we started seeing private equity firms look externally at what opportunities there could be. And under distressed, I would say there are a number of subcategories. So you have maybe good companies, good assets, but maybe their balance sheet has too much debt on it. Is there an opportunity there? Is there a company that is really well, performing really well, isn't dramatically affected by COVID, but potentially has a cash problem, and rescue capital is an opportunity there. So we've seen some quite creative strategies for people to get involved with good companies, good assets. And then the flip side of that are the companies that are just straight distressed, that have seen revenues fail and are going to need to be restructured. So the chart that was put up at the beginning of the presentation, DataSite supported most of those companies in those Chapter 11 protection situations where they're looking to restructure their companies under Chapter 11 and come out with either renegotiated terms or certainly a kind of a buyout. So we've seen quite a range. And I think the third phase, which we're either maybe just starting or about to start, is going to be the companies that look to invest and have potentially different risk profiles. So earlier this week, Ken Mullis was on Squawkbox talking about companies that are prepared to look through COVID, that maybe have a longer term investment strategy and are prepared to get into the market, take the risk, and then obviously create that upside. Whereas some other investors may be more risk averse and still want to see if there's a second wave, and what other factors might impact them. Thanks,
Mark. Dovetailing off that a little bit, question from the audience for Peter. Are LPs happy with the strategy creep into stressed/distressed?
In fact, I guess I wouldn't contextualize it as happy. Good question. What it is they're, I guess, pleased with it because that is what LPs in fact are asking of their fund managers to do in most cases. We find that, with existing managers, they certainly, know and trust them. And so therefore they, are comfortable working with them as they, and usually it's a pivot that's a nuance to going after, again, as Mark Williams just noted, good companies that, if you look through COVID, will probably continue to perform as things normalize. So that's why they're happy to back those managers who can do that. In most cases, the managers that people are backing that will pivot into going after any stressed companies also have a notable operational team around them, former executives that can come in and add clear value to these companies and really help them perform. And that's a lot of times what we see the LPs appreciate when they look through what their fund managers is doing is, in fact, they're really helping these companies in many cases, whether it's on the financial side, maybe over-equitizing has been brought up by Peter, or coming in and really adding some operational value from these executives who have been through a cycle like this before, and maybe management hasn't, and can help them not only survive through it, but possibly thrive. So in fact, again, we find that LPs are really asking for this and kind of impressing upon their managers that that's what they want to do, again, is take advantage of the opportunity set for buying value in this dislocation marketplace.
Thanks. Peter Kaufman, anything to add to that?
Yeah, let me take a little bit of a different slant than my esteemed colleagues. And I know I'm the other Peter, so I'm okay with that. I'd like to talk about what's different today and what isn't different today. Both of my co-panelists have talked about how people want to find good companies with good assets but bad balance sheets. Name me a cycle where that hasn't been the goal. There's nothing new about that. What's new in this cycle, what's different than in the past, is in a lot of these industries, you can have no faith in projections. Nobody knows when the COVID impact is going to change or turn. Is there going to be a vaccine? Is it going to be effective? Are people going to use it? And then is business going to go back to usual? Will it be 2019 again, where the wine is flowing and the sun is shining? I am seeing industries that we're in, and that are very consumer facing, where I don't know that normalcy is ever going to return. Things are going to morph from more in-person to remote. Businesses are going to find a different way of doing things because the consumer is going to demand that they find a different way of doing things. And so you can have no confidence in projections in the companies that are being slammed by COVID. And you can have no confidence that their business model will weather the storm, and that when the seas calm, they're going to be floating the way that that they had been. So I think that's what's different in this cycle. It's not that people are looking for good companies with bad balance sheets. That's there's no difference there. What's different is you cannot rely on business models being static and going to be returned to the halcyon days of pre-COVID, and you certainly can have no confidence about projections in the industries that are currently being affected severely.
Thanks. Mark, question for you. How are corporates taking advantage of the current environment and accessing capital markets?
I think we've seen them be opportunistic. I think as the corporate strategy was maybe laid out at the end of 2019, getting ready for 2020, that took a hard pivot. And I think some companies were in a position to take advantage of that and maybe add to their product lineups. Certainly in healthcare and life sciences, we've seen a lot of partnerships where previously a company may be looking to go direct and commercialize, but they've accelerated that strategy and changed it to a partnership and a licensing strategy. So we've seen a range of corporates kind of change their corporate strategy. We've also seen some corporates divest assets where they look to prop up their balance sheet, or they look long-term are unsure about what that business unit is going to add or offer. So they look to divest it and, again, maybe be slightly smaller, slightly more nimble, and slightly more resilient.
Thanks, Mark. Peter Kaufman, I think you can speak to this well. When it comes to deploying capital for distressed M&A, how is private equity sourcing opportunities, and how is the current market impacting lender-sponsor dynamics? Are there defensive strategies being employed by sponsors there?
Well, I've talked a little bit about the dynamics earlier, Claire. Let me try and go a little more in depth. So private equity has two focuses. One is offensive, one is defensive these days. Offensive, they're trolling with everybody else, other sponsors, looking at bond prices, looking at places where they already have platforms to see who in that sector, is either publicly or in the press having issues, and figuring out if they can get a leg up and get something advantageous in bankruptcy or not. What we're doing a lot of on the defensive side for sponsors is going to lenders and showing them all the nasty things we'll be able to do to them in a bankruptcy proceeding, either a cram up, a cram down, some technical things. I'm happy to go into detail or not, a sale of the business. In any given situation, there will be strategies, usually bankruptcy centric these days, that the lenders won't want to have to address. That will give them great concern, as well as whatever liquidation value is. And we're counseling our sponsors to be candid and say the investment committee is never going to agree to put a lot more money here under the debt structure as is. And so this could be a liquidation. And frankly, in a lot of our client situations, the sponsor has already taken its loss. All of its money is gone, and the junior lenders are in peril. And frankly, the senior lenders in a meltdown are going to do terribly, and pursuant to some of these bankruptcy strategies will also do terribly. The tough part for us as advisors with sponsors on the defensive side is many of them are worried about the relationship with the lenders. Maybe they've got the lenders in other deals and may need other help, but they've got other investors in the equity. And so there's a tension between trying to do right by the investors and the company in a given situation, but being mindful of the broader relationship issues. And so that's playing out in real time for us and our clients. And there's dynamics and tension all around with that. But there's clearly a path in almost all of these situations where you can right-size the balance sheet or take the pressure off the company to deal with the debt that was incurred pursuant to a whole different world order. We've created something called debt spring back and spring down, where we go to lenders with what we call sticks. Here's all the terrible things we can do to you in Chapter 11. On the other hand, why don't you take a meaningful write down now? But if, as and when the company claws back to 2019 levels in performance and it's able to support the capital structure again, we'll allow you to spring back that written off debt to pre-existing debt in some way, shape, or form. And lenders aren't really happy about that, but that looks in some of these situations to them like a much better outcome than some of the more draconian bankruptcy-centric strategies.
Yeah, Peter's exactly right. I mean, what we're seeing today from the fund managers is where they're sourcing, their stress-distress type of opportunities today now is from their current relationships, whether it's, with the lending relationships that they're working with already to, in many cases, it may be the companies that they have been, monitoring for the last number of years, always wanting to do something with them. But until the dislocation occurred, maybe there was a pricing mismatch, or maybe the company or owner didn't feel they needed to sell and bring in, private equity. So now what we're seeing is in this dislocation from some of our fund managers, as Mark just pointed out, one of our managers will announce a corporate carve out from a large publicly traded corporation that is divesting a notable company to, work with their balance sheet. They probably weren't optimally running it within a large corporation, et cetera. That opportunity only became available because of the dislocation. Then even more stress distress We've seen fund managers who have been looking at, companies in the more consumer oriented who have just been, impacted horribly with COVID. This is now the time to really buy deep value. And so we have two fund managers that have been able to step in and really provide, that rescue type of financing. So, but it comes right now from the current relationships everyone has, because again, traveling, et cetera, is problematic. I think to your question earlier about, has this cycle been extenuated? I think the answer as we move forward, probably into 2021 and beyond, that's when you'll start seeing, private equity really go further afield, running, their searches, looking for companies that are outside of their current relationship base and pursuing them more opportunistically.
Great, thanks so much. Let's pause briefly to take temperature on a sector focus. So we're going to do another poll. Which sector offers the best opportunities for distressed M&A? So please vote on that. And while we are voting on that, let's talk about sectors. Our research has demonstrated that restructuring and bankruptcies are originating in energy, utilities, industrials, capital goods, while retail continues to give up its weakest members. We saw Lord & Taylor file for Chapter 11 this week. Peter, Kaufman, are buyers diligencing potential opportunities in these sectors, and how are buyers safely investing in deeply distressed assets?
Well, investing deeply in distressed assets safely, I don't know. That's part of the risk reward here. I don't know how safe it can be, but I think buyers need to have a vision about what they're going to be able to do with these distressed assets, particularly in the retail side, that the current owners haven't been able to do. Maybe they've lacked the vision, they've lacked the wherewithal. The buyer is fancies themselves more of an expert in consumer retail. I think that Lord & Taylor, Brooks Brothers, Men's Warehouse, they've just been slammed. All they're doing is online business. Nobody's going in the stores, and whoever's buying them has to believe that they're going to have a business model that will work or will work eventually, and that they've got the wherewithal to stay the course here, and that they've got a real cushion between what they've invested and what they think they're going to get back, so that their downside certainly isn't safe, but it's bounded.
Great. Peter or Mark, do you have anything to add to that?
Well, I think Peter Kaufman, hit it on the head earlier in his comments, as well as right now, which is, what we're seeing is that where people can look through and have a reasonable viewpoint on what post-COVID might look like, they're comfortable going after those type of areas. So maybe industrial and capital goods, right? We're going to still want to build things, et cetera. You can have a viewpoint on that. Retail becomes harder because, again, I think there's a reasonable argument for things are going to change from possibly the way, pre-COVID to post-COVID as to how we approached retail. So I think those are the ones that, are a little bit harder for finding, managers to pursue. So it's really that question of, how confident can you be in your projection going forward that this business or industry dislocated by COVID will survive and maybe thrive post facto. And again, there are clear ones that are the base of our industrial economy. There are ones that are more consumer oriented on the fringe, where I think there's a question, and the outcomes are wider, where it's harder for people today now to make that investing decision. So what we're seeing is more focus on those businesses people think will, revert to the mean, as they say.
Peter, this is the other Peter. I'm interested in your view of this. Retail for the past couple of years, the bricks and mortar have been increasingly impinged upon by the internet economy, and there's been almost no reorganizations of retailers, and not a lot of sales, not a lot of M&A, a lot of liquidations. And what's sort of fascinating to me about this cycle is that you're seeing some big name retailers that are filing not to liquidate, not to reorganize, but to effect an M&A transaction. And so it's sort of interesting to me that this cycle seems to be bringing that out in a way that pre-COVID that wasn't happening.
Well, they were still having the trouble even pre-COVID, because the phenomena that was occurring pre-COVID was, as we've seen, is a lot of these smaller brands, and that goes with the internet as well as the ability to deliver them. A lot of these smaller brands were coming in and taking market share in many cases that, the consumers, millennials, in the newer generations were pursuing, which then put these, we'll put a Brooks Brothers in there, a bit out of style already. And then of course you hit this air pocket, and it's been exacerbated in retail. So I think that's where retail is going through a number of different cycles, whether it's the classic model of bricks and mortar to internet, to then the demand of what consumers want, because now they want more individualized brands that seem to pop up and people get into, and we've seen a lot of those individuals become billionaires out there behind the brands quickly. That's because of pivoting tastes and also what we do with it. But it's a good point, Peter.
Well, are you saying I'm not stylish? And this is a Brooks Brothers jacket. I mean, come on, I just got it.
I'm saying
This
you
is
and
worth
I will possibly shop from Brooks Brothers, et cetera, and probably, are trying to think about whether we take advantage of the sales that are going on. I'm going to bet a lot of our younger colleagues are not even, considering that.
I think one thing I would maybe add to what Peter and Peter have said, we supported Lululemon's acquisition of Mirror. And I think as consumer attitudes change and buying patterns behave, certain companies that take a new approach to how they're going to reach the consumer is going to be very important. And, I think it's not just acquisitions in, kind of acquiring a brand or acquiring a label and things like that, but I think it's looking at acquisitions in the supply chain and looking at acquisitions in the technology-enabled route to the consumer is going to be interesting to watch and see how that plays out in the future.
You're right, Mark. I mean, the big theme that we're seeing, obviously, across everything, but here even what's happening is the ESG SRI type of focus, right? People now want to know, how their clothes are made, what they're made of, et cetera, and does it meet their social viewpoint on things. So it is interesting, because you're absolutely right. We've seen that back channel, work through the people really, therefore deciding who they want to buy from, how they want to buy, and what they want to support. So retail is certainly going through a lot of changes, which I think makes it, an opportunity, but also makes it challenging for private equity buyers.
Great, thanks so much. Want to be mindful of time, but did want to say that overwhelmingly our audience poll results show that 50% think retail will be the strongest sector, with 25% in energy, 21% in industrials, and only 4% for utilities. So sort of lines up with what we're saying here. I've got one more question, and then we'll turn it over to audience Q&A. But I think I'll start with Mark. We're coming off of an era of increasingly crunched sale process timelines spurred by pretty intense buyer competition. How is the current environment impacting the average length of time it takes to get a deal done?
We've seen a number of interesting things happen. So obviously we are a virtual data room, and the virtual data room, I remember when I did my first M&A acquisition was in a physical data room. Now some bankers don't even know and have never actually been in a physical data room. So it's kind of the end of an era. We've seen a real increase in some of our more advanced functionality. We monitor what functionality gets used on our platform. So certainly as in-person meetings have not been possible, we've seen an increase in that usage. And as the due diligence has got a lot tighter and people have really dug into the details, we've seen some of those advanced capabilities be used more regularly. And what's interesting for us is once they get used, we then see them getting used on the second and the third deal, and that's a change in behavior. So for us, obviously, we've taken a position to build these capabilities. We're encouraged by that usage.
Great. I think we will turn it to audience questions now. So we've had a couple come in on 363 sales. So I'm going to try to combine those. Just how should buyers look at financing, a distressed deal or a distressed asset from 363 sales? Can any of you give some context regarding financing on these types of acquisitions?
Well, I'll jump on that first. The most important thing about financing in these deals is certainty. You can't be a player and a credible player in a 363 if you don't have certain financing, especially if there are others around the table, even at a lower price, that do have certain financing. Right? The courts are always looking for what's called highest and best bids, and if you're the highest, but you've got financing contingencies, you're probably not the highest and best bid. A lower bid that with no contingencies is often will beat that. So the most important thing is to have no contingencies. How you line that up, staple financing, your usual lenders, equity, whatever it is, certainty is the most important thing.
Great. For stress companies where free cash flow to the firm ends up matching debt obligations in the long run, why would debt holders be willing to exit the debt at depressed market levels of negative 50% when they can sit and wait repayment? Anyone can take this one.
Yeah, I mean, I guess I'll start. Peter's probably, the professional here to some extent, but what we're seeing there is it's behavioral finance, psychology in many cases that, whether, there isn't that level of comfort and certainty in that outcome you outlined. And then, people are willing to kind of cut their losses and move on more quickly. So that's what we're seeing. And I think, for some others, that's where the opportunity set, in this dislocation steps in. Peter?
I couldn't improve on that answer. Bang on.
Great. Sounds good. Mark, anything to add there?
We just support it. We don't have a view on it.
Sure. Okay, I think we're looking at wrapping up here a bit, but I want to thank our terrific panelists so much for joining us, for sharing your insights, and to everyone for tuning in. Hope everyone is keeping well. I'm going to hand it over to Mark for some final remarks, and then we will close up.
Great, Claire. Thank you. Well, as you said, thank you very much to our panel. I thought it was interesting, certainly, Peter Kaufman's comments on offensive and defensive strategies, the spring up and spring down. I'm going to do some more research on that and track that going forward. Thank you to the audience, especially for all of your participation. The DataSite Global M&A Report is available for download in the Mergermarket console. I encourage you to check that out. We do more virtual data rooms than any other provider globally. And we surveyed more than 2,200 deal makers in that report. So I think you'll get some interesting insight. In addition, we've also got a range of resources and materials for the community on datasite.com. So if you visit there, if you've enjoyed this content, I think you'll find more things there that you get value out of. And yeah, would like to thank everybody for the time. We're going to continue these types of discussions for the community. Everybody stay safe.
Thanks so much and stay healthy.
Thanks, Mark. Thanks, Claire. Thanks, Peter. And thanks, everyone.
Thanks for including me.